Hi everyone, it's Katya and welcome to my channel. Today we are talking about interest-only mortgages. So let's get started. First of all, interest-only mortgages are non-QM mortgages, non-qualified mortgages, which means that those are not Fannie or Freddie or Ginnie material. That in itself means that interest-only mortgages are either going to be retained by the lender himself, so meaning that they will be kept in warehouse line of credit by the lender, or they will be sold directly to the investors if they will be interested in such loans. So the interest-only mortgages are structured that way that for a fixed amount of time, you will have an interest-only payment. And after this fixed amount of time is up, this is when your payment is going to be restructured and a principal amount will be added to this interest-only amount. Those mortgages are coming just like ARMs, adjustable rate mortgages, are coming in different varieties. For example, 3-1, 7-1, 5-1, 10-1. It really depends on what fits you the best. So as just like in adjustable rate mortgages, 7 stands, let's say we are picking 7-1. So 7 stands for a number of years where you will have an interest part payment only. After this 7 years is up, on year 8, your payment will be restructured to have a principal amount added to it. And this is when your payment goes on to repaying your actual amount owed to the bank, your principal. Now, the number 171 stands for how often your interest rate is going to be adjusting. In our case, is number 1, so it's going to be adjusting annually. Now, there are a few options for interest-only loans. First one is a fixed rate, second one is a adjustable rate, and the third one is fixed payment. Let's talk about a fixed rate first. So in a fixed rate, which this option is not very common, but they do exist. In fixed rate only mortgages, your payment will be structured, let's say 10-1. So for the first 10 years, you will have a interest only part of payment, and after year 10, so when the year 11 starts, you will be rolled over to a interest in principal as well. In these cases, because you were not paying your principal for 10 years, majority of the times, I would say, your payment can nearly double. And I will include a short video from a interest-only mortgage calculator that I'm using just to show to my clients, so you can be aware of how the payment is changing for first 10 years and for year 11 and going on.
This is a simple calculation for interest-only mortgages. I usually go to calculatorsoap.com. I already entered a loan amount of $200,000. 360 months is standard for 30 years. Interest rate, let's say it's going to be 4%, and interest-only term is going to be 10 years. So after you click calculate, you will have an interest-only payment for a first 120 months of $667. And after 120 months is up, your payment will be recalculated to integrate a principal part into it, and your payment will nearly double, so $1,200.
Second type is adjustable rate interest-only mortgages. Those work very similar with just adjustable rate mortgages. Well, let me explain you a little bit more. For example, if we are taking 10-1, let's say, so you will have a interest-only portion of the payment for first 10 years. And after the 10 years, when year 11 comes, your payment will be restructured to have a principal portion added to it, and since we have a 10-1, your interest will be changing on an annual basis. So as we know from my previous videos, the interest rate that is offered for you is made of two components. First one is a prime rate or federal funds rate, and the second one is a margin. So margin stays the same for the life of the loan, and the prime rate is changing. In our case, it's 10-1, so it will be changing on an annually basis. I will include a video talking about rates more right here for you guys if anyone is interested. Third option is fixed payment option. From one point, it's a great option, especially if you're planning to keep this mortgage for a short period of time and the interest rate on the market is low. In that case, you kind of have like a fixed payment for an X amount of years. Now, if you're planning on keeping this mortgage for a longer time, that might be not such a great option for you because, for example, if the interest rate will go up and your fixed payment it's let's say $1,000, you will be paying not enough funds to cover what you are due, which will cause a negative amortization. So be very careful when you're choosing this option. There are a few important things that you have to keep in mind when trying to get an interest-only mortgage. Well, first of all, your FICO score has to be at least 700. Second, you will have to have at least 20% down payment. Third, not every single person can qualify for this loan. Fourth, a benefit of interest-only mortgages is usually interest is a little bit lower than it is on traditional mortgages and traditional FHA and conventional with a fixed rate. And finally, the closing costs for interest-only mortgages are on the higher end versus the traditional conventional or the FHA. So what are the benefits? Why should you take an interest-only loan? Well, first of all, having an interest-only part payment for, let's say, 5 years can significantly reduce your housing expense. So if you are looking to have a lower housing expenses, this is a great option for you. The only thing is you would not be building up any equity. You basically will be living at a reduced rental rate. Secondly, if you do not want to wait any longer and you need to move into your dream home now, this is a great option because that way, with interest-only mortgages, it gives you enough time to get additional funds, to get a better job, to save up some funds so that you can start paying off your principal when the time gets to it. Third, well, let's say you want to get an investment property that you are looking to flip and sell within the next 4, 5, 6 months, well, interest-only mortgage is a great option because that way, without you covering a principal part and covering only an interest part, you can dedicate more funds to the expense that needed to be covered with flipping this home, for example. And finally, if let's say you are not 100% sure what you want, where you want to be in the future, for example, if you want to stay in the state of Georgia, you want to move to state of California, it's a great option for you because that way you can kind of figure out what you want and that would not cost you much. So it's a great option to consider. Now, why you should be careful when considering a interest-only mortgage? Well, first of all, you would not be building any equity in your home because you are mainly making an interest-only portion of the loan. Second, you will be taking more risk because if, let's say, an interest rate goes up significantly, your payment will go up as well. Third, if the housing prices drop, you might be upside down on your loan. And fourth, depending on what kind of option you are choosing, if it's either adjustable rate mortgage, fixed rate mortgage, or a payment only option, fixed payment option, you might be building a negative amortization in your loan, which can potentially cause some harm to you in the long run. So to sum up, an interest-only mortgage can be a great option for someone who is looking to reduce their housing costs, especially right now in 2021 because the interest rates are very low. Or if you are looking to have a investment property flipped and resold quickly, that way you are saving more funds with a reduced housing expenses. Now, you have to be careful and consider a negative amortization possibility because that can cause a lot of harm to you in the long run. So thank you so much for taking time to watch this video. If you have any questions, as usual, I'll be more than happy to answer those for you. Please comment below. Feel free to send me an email or a text message. I'm always happy to help. If this information was useful for you, please click thumbs up and subscribe button so next time my video comes up, you will be notified. Thanks again for your time and you folks have a great one.